What's up, traders? I hope you're all doing well. Thank you so much for clicking on this video, watching this video. Thank you all for who likes the video and videos in plural. Thank you all for watching, commenting, liking, subscribing to the channel. Just a little bit of gratitude from me to you. Thank you. We have a free Telegram group. The link is in the description. Go join. It is free. We currently have 41 members in there right now. I am sending my trade setups that I'm live testing and kind of walking through my analysis, how I'm feeling about the setup, what I think about it. And I'm also kind of documenting like live testing, taking the setup, if that makes sense. So someone on the last video commented and they asked, how do I backtest? What platform do I use? And thank you again for your comment. I really do appreciate it. So the way that I backtest is actually with hindsight. I backtest on TradingView. I'm going to show you that. And then right now I'm live testing. And this is kind of my way of back testing. Right now I'm live testing and I'm sending those live tests in that Telegram group. With these live tests, I'm documenting it as if I took the trade, what I would do, how I'm cutting risk. I'm taking my back test notes and I'm applying them to the live market now and applying it like if I'm taking actual trades. So that way I can see if I'm making any mistakes, and then I can kind of like stay more clear of those mistakes, if that makes sense. So I'm gonna bring up the chart right here. You can see right here we got USD JPY. Now on this, what I like to do is I like to go to my smallest time frame that I'm gonna use, and I'm gonna go to as far back as price lets me. So the furthest that it lets me go back is right here, okay? This is January of 2022. So with that being said, if I'm going to use the 4 hour and I'm using the weekly, this is going to be my trading approach. Okay. So from over here, I start with the weekly time frame. Now you could do with this with the monthly and daily, but the weekly and 4 hour is kind of my bread and butter. I like to start with the weekly time frame, and I like to find out what is my next draw on liquidity. Draw on liquidity being internal range liquidity or external range liquidity. And you can kind of see right here, we had this swing high right here, swing low right here, and then it made these relative equal highs right here between these two, right? For price to then target and take out, and it just kept moving upward from there, right? So with back testing hindsight, if we look right here, we had this expansion through this high right here. This could become your range that you could apply your Fibonacci off of. Remember the last video that we just uploaded and talked about ICT concepts made easy? This becomes your range right here. So that way you can find your discount price, which is going to be below the 50%. And you can see it dips into discount. What does it tap into? It taps into this last down close candle, which is also an order block. And from there, that's whenever we can drop to our 4 hour time frame and we look for a market structure shift bullish off of that weekly fair value gap, right? Now, what you always want to do is you also want to like pay attention to any times you have taken a loss. Whenever you're back testing in hindsight, also apply losses to this. Don't be greedy. Don't obviously like you want to do it as if this happened while you were trading it, right? So right here, whenever it taps into that weekly fair value gap, or not fair value gap, I'm so sorry, it's a weekly order block. As soon as it taps into that weekly order block, that's whenever we look, where is the most recent 3 candle wick swing high from this candle? And I see it's like right here. Boom, 3 candle wick swing high is here. We've talked about 3 candle wick swing highs many times in the previous videos. Go watch those videos and you'll see what I mean by that. Then we have this one that gets created once this candle closes. And then from there, price actually closes above it. So we have this market structure shift bullish. We have the change in the state of delivery from this candle right here creates this breaker block right here. And then we also created bullish PDAs with this bullish breaker block, this bullish fair value gap, and this bullish fair value gap. we disrespected bearish PDAs, this bearish fair value gap, and this bearish order block, this up close candle right here, and also this bearish fair value gap. And look at how that candle also closed above, or that's not really much of a gap, but it's a tiny little gap right in there if we like extended price a little bit more. But you could kind of see it. This is your market structure shift right here, right? So from here, what I like to do is I like to dollar cost average, and I like to identify the different PDAs that are within this leg that price can potentially retrace into, right? So for example, we have this fair value gap, this fair value gap, and then we have this breaker block right here, right? Boom. And what I like to do is I like to take entry. Let's say that I'm comfortable with risking 1%. If there's 3 PDAs, I'm gonna split that 1% up in 3. If there's 2 PDAs, I'm gonna split that 1% up into 2. If there's 1 PDA, I'm not gonna break it up, right? So with this one being 3, I'm gonna split that 1% up. It's gonna be 0.33%. And my first entry, 0.33%, will go down right here at this fair value gap. Second one will be a buy limit right here at this fair value gap. And the third one will be a buy limit right here at this order block, right? Boom. Those are going to be my 3 entries, okay? And where would my stop losses be? I would take it all 3 and I would put my stop losses below them. And you can see with this little wick right here, it wicked below, right? It didn't close below, it wicked below. But what I like to do is I like to give it just a little bit of breathing room right below this area. So I like to go to the next pip. It's 90.7. I'm going to go to 91 on this one. So 91 pips right here. This is the price. I'm going to copy that price, and that's going to be my stop losses for all of these trades. 0.33% going down on this setup, right? Boom. 1%, I should say, going down on this setup, right? So right here, let's say all 3 of these got stopped out. Minus 1%, we got stopped out on this wick right here. Again, you could be like, no, I didn't get stopped out. I didn't get stopped out. No. Bro, just be honest right now. We are back testing in hindsight. Be honest with yourself. This, I am considering it a loss. Minus 1%. Now, again, if you thought we win every single trade, newsflash, you don't. Nobody has a 100% win rate. Dude, it's hard as shit to even have an 80% win rate. 70% win rate is where a lot of good traders is at. But there's this guy even on X, Twitter, if you know it as that. But there's this guy on X from 2023 to now, within that 2-year span, he has made 61R on his account. To put that into perspective, 1%, so he has a 100K account. He has made $61,000 on that 100K account within the 2 years, and he has a 31% win rate. His win rate is so low, but he's still up $60,000 within 2 years. Now, I know that doesn't seem like much, but a lot of like hedge funds and big firms, they aim for a 10% gain per year. This dude has earned 61% over 2 years. That's 6 times what hedge funds and big firms actually do. Like he's outpacing even the S&P 500. Like that's to put it into perspective for you guys, okay? Now, if you have like $1 million, that would be what? That would be $600,000 return within 2 years. You know what I mean? Like it just takes more capital to receive more. You know what I mean? And he's just compounding his account. He started with the 100K, now he's at 160K, and now he's risking 1% based off that 160K. So it's not just $1,000 anymore that he's risking. Now he's risking 1,600. Whenever he gets to 200K, he'll risk 2,000 because that's 1% of his 200K. You know what I mean? And so, like, compounding effect, things like that. Again, getting back to it right here, 1% loss. Okay. So, what I do now is I cut risk. I'm going to prevent my account from bleeding. So, if I'm okay with risking 1% on the first trade and it loses, and I'm down 1% on my account, my next trade, I'm going to risk 0.5%, 0.5%. And since I got stopped out here, we are still within that weekly order block, that weekly PDA, and I'm still looking for buy opportunities. So right here, what I'm looking for is I'm resetting and I'm looking for a new 4-hour market structure shift bullish, okay? So whenever it takes us out, I'm going to look back. Where's the most recent 3 candle wick swing high? And you can see it's right here. Boom. And then this one gets created, okay? And then this one gets created. And then this one gets created. And that's whenever price market structure shifts right here. Boom. This is the market structure shift candle. This candle creates this fair value gap. Another fair value gap is created. So we have a market structure shift with displacement creating bullish PDAs. Also closed above these down closed candles, order block sequence right there. And it also closed above this bearish fair value gap that held in the past. You can see right here, it held and it sent price lower in the past, again, lower in the past. And then right here, it was failing to break above even right here. This was a very strong area. And you can see this candle closed above it, but market structure shift hasn't happened yet. It disrespected a very strong area that sent price lower multiple times in the past, right? So like you have to put all of this together and kind of like build a logic behind why should price go higher, right? Apply logic. Don't just be blindly entering these trades like why is price going higher? You should know why price is going higher and you should accurately be able to explain. You know what I mean? Now, why is price going higher? Because weekly has retraced into discount within an optimal trade entry, applying that Fibonacci, remember, from low to high, measuring the range of that expansion leg, and it tapped into a weekly order block at the same time. So we have layered a PDA on top of another PDA, that optimal trade entry with the weekly order block. At that point, since we're bullish, we're in this bullish scenario, we're going to drop to the 4-hour and we're going to look for a market structure shift bullish reversal sequence, right? And that's what we're looking for here. As soon as we get that sequence, why should it go higher? Well, because it's creating these new bullish PDAs and is closing over and disrespecting these old bearish PDAs, right? And ICT himself says if two PDAs get disrespected, chances are your ass is next, right? So in this scenario, like price has not only market structure shifted, price has not only created displacement with bullish PDAs, price has also disrespected these old bearish PDAs that have held price and sent price lower multiple times in the past. That's applying logic and explaining why price should go higher, right? So right here, as soon as this price closes above, we look back and we look for PDAs, right? From here to here. You also have this one right here that gets created, boom, boom. As soon as this candle closes, right? And so with this one, what could you do? Well, you could say, I took entry off of this one. Would you react quick enough though? Or would you wait for this one down here? What you can do again is you can put your entry here, stop loss below here and whatnot, or you can wait for that expansion leg. And this is going to be your dealing range. You apply your fib from here all the way up to that high to measure that retracement into that optimal trade entry, that discount price. What's also within that area, we have the fair value gap here. Price does close below it. It goes deeper into this fair value gap right here, right? It does go back into that area eventually, okay? After that PDA, okay? And then with that too, Does it tap into that? Look at how interesting, right? It almost does. It doesn't necessarily do it. It almost comes back into that wick right there. So like these are things that we're just observing and we're building an intuition while we're back testing this hindsight, if you will. Okay, we're building our intuition and we're understanding what price does when price reaches these levels. You know what I mean? Right here, price had this expansion and it had this retracement. It's a deep retracement, you know what I mean? Now, if you would have taken an entry off of here and stop loss would have been below, like right here, you would have got stopped out. If you would have taken an entry off of one of these fair value gaps and stop loss would have been right here, you would have got stopped out. You know what I mean? And so ICT says himself, whenever you get that market structure shift right here, once this candle closes, you look back through there and you look for the PDAs through there. This candle closes and it creates another PDA with this candle, right? And you look back through there and you find opportunity within that optimal trade entry from the 61.8% to the 79%. Within that area is that fair value gap, and that's where you can find entry, right? Let's say that you even took entry, we again dollar cost averaged, right? Let's say that there's these two PDAs within, or even let's do one better. There's these three PDAs, right? Three PDAs within discount. There's this bullish order block, this down close candle. There's this bullish fair value gap and this bullish fair value gap, okay? And with that, what you can do, enter your first one here. Stop loss would go below all three. And with this one, I put my stop loss below the one candle of the fair value gap pattern. So the fair value gap pattern is a 3 candle sequence. So you have the first candle, second candle, and then the third candle. And the third and the first candle are the ones that we connect the wicks to get the gap, right? And so I'm going to put my stop loss below the one candle. And that stop loss, again, I put it a little bit of breathing room to the next pip. This one's 91.9. So I'm going to put it at 93 to give it a little bit of breathing room, okay? And this price, this stop price, I'm going to apply it to all of my limit orders. So I have this buy limit order right here. Boom. And then I have the other one deeper over here. Boom. Right there. Okay. So I have all three of my trades. Again, I cut my risk from a 1% to a 0.5%, right? So if I'm taking 3 trades, split that 0.5% into 3. Let's just do some really quick math. So 0.5 divided by 3, it's going to be 0.166% on each of these trades, okay? And for the first one, I'll target a 1 to 2R. And what I like to do is with the second and third one, I'll hold them for that same take profit as the first one, right? Because in my trade, I need to see that first trade hit a 1 to 2R to be profitable, right? If it don't hit a 1 to 2R, then it's going to lose, of course, right? So since I'm risking 0.5% in total, I'm comfortable with that whole 0.5% being lost. And I'm going to go ahead and take those other ones because they have the opportunity to hit a 1 to 6 and also a 1 to 3, right? Instead of just a 1 to 2. And so you can see with this one, price ended up taking a little while to move away, but it ends up hitting that take profit, right? And so if we go ahead and take that 0.166% that we risked on each trade times 2, 0.33 plus 16. So it's wait. So it was 0.166 times 2 equals 0.33. Let me write this down somewhere real quick. I'll just write it down right here. Plus 0.33% plus 0.166 times, what was the next one? It was 3 equals 0.49, 0.49%, nearly 0.50. And then this one was a 1 to 6.6. So 0.166 times 6.6 equals 1.09 plus 1.09. So if we take that all together, 1.09 plus 0.33 plus 0.49 equals 1.91 minus that 1% we initially lost in the beginning. We are up 0.91% on this trade setup right here, okay? And so that's how I would go ahead and back test. And now from here, what I would do is as soon as that trade sequence has like ran and done its thing, now like whenever the 4 hour has market structure shifted bullish, then I in my mind see the daily and the 4 hour to hold bullish PDAs, right? So you can see from there, it has this expansion leg higher, okay? So if we deleted like this fib right here, you can see it has this expansion leg higher. And this is interesting because this is where you can apply a Fibonacci within a Fibonacci, and you can measure a range within a bigger range, okay? ICT talks about this too. And so from this low right here, where we got our entry off of, up to this high right here, we extend that out, you can see price comes back into that discount optimal trade entry area, and we're applying this off of the daily. Again, you can do it off the 4 hour too. The daily just cleans it up because the 4 hour will have a lot of like more candles, and you might take that as noise. You might get confused by it. So to prevent that, because right here, it goes up, it starts creating all these up close candles and whatnot, and then boom, it just has this big movement lower. But if you go to that daily and like that weekly, you can kind of understand a little bit better because it clears out a bunch of those 4 hour candles. But right here, measuring a range within a range, we have price come into the discount area. In that discount area, we have this down close candle right here, which is going to be that order block candle right there, right? Boom. And then price comes into that area. Since it's a daily PDA, you could drop to the 1 hour and you can look for a 1 hour market structure shift off of that area. It's totally up to you. Of course, we are all our own traders. It depends on how big of a stop loss you're comfortable with or what you're comfortable with as a trader. Again, I'm a swing trader, so I would go to like the 4 hour personally. And I mean, it's all the same. We're still going to see a market structure shift on the 4 hour, just like the 1 hour. But the 1 hour is going to happen a lot earlier than the 4 hour. The 1 hour is going to give you an entry earlier than the 4 hour. And the 1 hour is going to give you a tighter stop loss than the 4 hour. So again, it's your preference. If you want to be a little bit more conservative like myself here, I'm going to stick to the 4 hour. If you want to be a little bit more of a riskier trader, if you like to live life on the edge, carnal, that's totally up to you. I'm down with it. I'm with that all the freaking time, know what I'm saying? And so right here, you have price tap into that daily order block right here. Initially, it tapped into it right here. If we look for the 3 candle, it's way up here. And then they create the new ones here, new one here. So once it taps into it, right? Taps into it right here. Boom. Then we have this 3 candle high. Boom. From there, it does not market structure shift. You see what I mean? It doesn't close above it. Kind of respects that area, right? What is it actually respecting? This up close candle, this bearish order block right here. You know what I mean? And so right there, you can see that it creates this new 3 candle wick swing high right here, this new one right here, new one right there, new one right there, new one right there. See how I just applied it to the top? And then from right there, look at this. Huge displacement creates a big bullish fair value gap. Another one right here creates this huge breaker block right here. This is going to be a breaker block because it took out this liquidity low right here. So you have this breaker block within a bullish fair value gap. If you wanted to apply your Fibonacci, you're changing the state of delivery right here. Boom. You can see it came into that discount optimal trade entry right there. And again, you could dollar cost average. Now that we're up positive, we're going to risk 1% on this trade. We can take our cut risk that we risked 0.5% on. Since we came back on our account and we're in profit, we're going to go back up to our 1% initial risk. Okay. So right here, we have that fair value gap, but we're going to wait for it to come down into that discount area. And that's where we're going to enter. That's where it also meets up with that order block area right there too. So if we have that order block, we also got this fair value gap down here. What I would do is I take my 1%, cut it in two. And so I'm going to risk 0.5% right here. Now I know there's 3 PDAs, but the first PDA is way up here, still in a premium price. It's not in a discount quite yet. And so I won't take that one and consider it. I won't split my risk up and divide it up based off of that. I only want to go off of the two, right? That's within discount. My first one is going to be right here, and my stop loss is going to be below both PDAs. It's going to be right here at 70 pips, right below that 100. I'm going to take that stop loss price. I'm going to apply it to both of my trades. So my first entry went down there. Second entry went down right here at the next fair value gap. Boom. And for the first trade, I am targeting a 1 to 2R. And the second trade, I am targeting that same profit level price. And it's going to be a 1 to 3.2. And you can see first trade hit plus 0.5% plus 2, that's 1%. And then if it's 0.5%, I'm going to have to do the math for this one. 0.5 times 3.2, that's 1.6 plus 1.6. So we got 2.6% plus 0.91% equals 3.51% here on this setup as well. And that's how I do it, you guys. And from here, again, now that 4-hour has market structure shifted bullish, the 4-hour and dailies should coincide. And then you're looking for a weekly power of 3 as well. You know what I mean? If you want more insight on that weekly power of 3, because what we just did is more market maker buy models. If you want more insight on that power of 3, drop a comment. Let me know down below. If you got some value from this video, drop a like. If you're not subscribed, I hope you subscribe and click the bell so you know whenever we upload, you guys. Again, thank you so much for watching this video. We'll see you in the next one. Peace.